Hi, good afternoon. We're Synergy Capital Solutions. My name is Cliff. These are my colleagues Shanil, Christopher, and Jacob. And we're here to present to you a project we feel would yield the highest and best use in a property in Hudson Yards while giving you a maximum return. Christopher, if you would. Thank you. So we feel that residential luxury apartments with ground floor retail space will yield the best return in the Hudson Yards market. Now I'm going to take you through a series of 4 steps that covers demographics, large markets research, financials, and marketing to show you that our project will cover more ground and be more profitable than commercial office space and residential hotels, retail hotels, I'm sorry. So now take a snapshot of the area and look at some demographics. The population in Hell's Kitchen is about 46,204 people per square mile, and the median age is about 36 and 7.7 years. It's a working class society. There's high pedestrian traffic. As of right now, Hudson Yards is undergoing a revitalization through a series of both private and public works. New parks, public parks are being put in, and new centralized subway station entrances are being put in. They're turning into a transit-oriented high urban area. The average household income is about $64,796 per household. That's about 15 to 20% above New York's average. It's also a concentrated area of growth, as I mentioned before. A series of private and public works are going in for both residential, office space, and commercial space. Next, please, thank you. Average family size is about 1.7 people per household. My colleague Christopher will go into that a little further with our vision. That's how we kind of came about our bedroom sizes. The average density is 41,663 people per square mile. Hell's Kitchen is about a 1.5 square mile area, so it's very dense. Like I said, a very high pedestrian traffic will be great for our ground floor retail space. About 48% of the occupied rentals in Hell's Kitchen are 1 to 2 bedroom apartments, and it's a largely white collar area. Now I'm going to bring in my colleague Jacob to talk to you about a little larger market trends. Jacob?
So we're basically going to look at some macro-based variables right now that could potentially affect our project going forward. One of those variables is historically low interest rates, with the 10-year getting as low as 1.7% right now. And we know this isn't going to last forever, so we've estimated a range which is 4.6% is the historical average going back 150 years. So next slide. So why are interest rates so low right now? The Fed's foot is on the gas pedal right now, and it's artificially propping up the value of all asset classes, which includes equities, bonds, and real estate. And as you saw during 2008, markets are interconnected. And when you had that massive drawdown in the stock market, construction projects came to a grinding halt. So look what happens when the Fed takes their foot off the pedal. You've had massive drawdowns in the stock market. So, next slide. What type of project is going to best mitigate our risk and going to be able to weather this eventual tightening? We've done luxury apartments. Why? Transparent cash flows, historically low vacancy rates. And going forward here in a low to stagnant environment, we feel that this is going to have the best choice to optimize the cash flow for investors with taking the most minimal risk. Go forward. So a rising tide brings up all boats. But the historic 30 years before this, you had growth in the housing market. But over the last decade, you've seen a shift in that trend, and you've seen a rise in the rental market. Why is that? People need to be mobile. They need to go where the jobs are, and they want the convenience of city centers. It's a major portion to the population right now to have all-inclusive services of mass transit. And they don't want the debt that's included in owning a home. People need to be versatile. So how do we capitalize on this vision, on this macro-based trend?
All right. Now you've all been waiting for our product. Our vision consists of 2 components, luxury 1+ and 2+ bedroom multifamily rentals and a ground floor retail center. Now, to limit our risk in our idea here, what we've decided to do is subdivide it into 2 separate LLCs. The names of our LLCs are Annex LLC and Basilis LLC. They both mean leadership in Greek. Now, we did this so that we would be able to separate both businesses and be able to sell one off into the 4th year. It makes it much easier when doing the process. The first thing that I'd like to talk about is Annex LLC, which is our retail space. This is our ground floor and partial second floor retail space that's 19,176 square feet. Some of the people that we would look to put in our building would be either Panera Bread, a Walgreens, a Starbucks Coffee, or a Chase Bank. Reasons we would want to put these in is that it would provide convenience to our luxury apartments as well. People don't usually want to walk more than 5 blocks when they're living in an apartment. They want to stay close to home. They want convenience. So with our Class A building, we feel that we'd be able to attract credit tenants like this, and the retail demand is increasing in New York, so the mindset is that this is profitable. Our second LLC is Bacillus LLC. It consists of our 1+ and 2+ luxury bedroom apartments, which consist of 120 of our units. Altogether, we're at 200 units because of our affordable housing, which we use to achieve the beneficial tax abatement. So because we have the affordable housing tax abatement, that brings down our costs. But the 1+, 2+ luxury bedroom options are appealing to our market because we have two different sections. By doing this, we're not just offering 1+ bedrooms. We'll be able to fill these because it will give them several options. We also still focused on the demographic of the 1.7 per household by doing this, just to make sure that we still capture that market. On each floor, we have 16,520 rentable square feet per floor. We also have a 5,000 square foot lobby allocated on the ground floor for our luxury tenants. In the ground floor, we would like to put in a few amenities, like a third-party concierge and doorman located in the lobby. But one thing that we would also like to do is we would tier our building. Floors 4 through 7 would be our base rent, but as the floors go up, it's obviously more valuable to live on a higher tier floor. So we tiered it that the floors 4 through 7 are the base rent, floors 8 through 10 are a little bit higher, and floors 11 through 13 are the highest rent. Another thing that we'd like to talk about is the loss factor. In the case, it's stated that 20% of our square footage would be used in common areas for the apartments. That came out to 45,490 square feet utilized for hallways, elevators, and stairways. In this, we also incorporated a common area fitness center and spa, because these type of amenities are very important in a luxury building. They are almost considered necessities when you come to a luxury building. People look for these type of amenities. Also, after developing the building, we looked a little further ahead. We looked into future options. We looked into rooftop optimization. Now, one thing that we could do is with a co-op organization called Inhabitat, which actually rents out space on these roofs to put in gardens. It's kind of the fiscally and environmentally responsible role, whereas they have the idea to grow vegetation on these roofs. Now, by doing this, this will lower our heating costs and our cooling costs substantially, and also protect the investment. It helps protect the roof of the building. So it's actually very viral in New York at this point in time. People are putting these green gardens on these roofs. Now what I'd like to talk about is we would like you to flip to your back 2 pages, which is the pro forma, and Chanel will talk about that. Thank you.
Okay, on to one of the most important questions of this case, determining land value to establish the minimum and maximum bid for the cost of the land. Now, we ran some comps on Real Capital Analytics, but they were all over the place. It's kind of hard to get a true sales comparable in Manhattan. It's so different block by block. So we decided we're going to use the residual land value approach to determine value through yield capitalization. So we ran out a 10-year stabilized pro forma, started out with our retail rents at 3% escalation, added our parking income and affordable housing rent, plus our total residential rent escalated at 3%. We summed that up to get our PGI, deducted 3.5% vacancy to get our EGI, and deducted our expenses to get our project NOI, carried it out 10 years, then assumed sale based on year 11 for both properties. So we took this and we ran a discounted cash flow. We used 2 discount rates, 15% and 12%. 15% because it's the upper echelon of the yield required by investors, and 12% because it's the minimum yield required by investors. So when we ran a DCF at 15%, we get a net present value of the property at $168,290,000. We deduct our fixed construction costs of $104 million to come up with the land value at 15% of $63,458,000. This coincides directly with our maximum loan to cost ratio of 62% that was provided by the case. That's our opening bid. When we ran the same DCF at 12%, we come up with the land value at 12% of $103,143,000. This is our maximum bid. Why? This is the maximum we could pay for this property to deliver the required minimum yield to investors. After we have our land purchase, it's on to the waterfall cash flow distribution. Okay, first we got to get our cost basis. We're going in at our maximum bid to be conservative. That's $103 million. But we also need 2 years worth of construction interest to pay off the construction loan interest. That comes up to $15,200,000. We add that to our cost basis to get $118 million. Divide that 95 and 5 to the GP and the LP. LP is responsible for $112 million, and UDP puts up $5.9 million. So now on to running the cash flow of the project. First 2 years, no cash flow, but we pay off the construction loan interest from our reserves. Switch over to perm financing at 6.5%. Year 3, we deducted 23.5% off the NOI to account for the lease-up period. So we start out with our first positive cash flow of $2 million, 95.5 to the pref, but pref's been running from day one, so we have to carry the pref over into the equity balance of the next year. Year 4, we sell our retail at a 7% cap rate, pay off our debt service, and pay down our equity balances for the GP and the LP. 2 more years of positive cash flow. In year 7, we sell off our residential at a 5.25 cap rate, at least 100 basis points higher than what cap rates are today for luxury retail, luxury residential in Manhattan. When we sell this off, pay off our pref balances, we pay off our equity balances, we end up with $139 million cash for distribution. Now, before we do the waterfall and split up the cash, we run a check on the IRR of the LP's IRR from the equity and pref payback. It comes out to exactly 8.000%. That means this waterfall has been constructed correctly so far. Now it's on to the profit share. We run a goal seek to 12% to find out how much the LP is required to reach his 12% hurdle. We take that, divide it by 0.75, that's the total amount of cash required for profit share 1. It's going to end up being $42 million to the LP and $14 million to the GP. On to tier 3, 65-35, $54 million to the LP, $29 million to the GP. This waterfall structure, it provides 2 things. It provides protection for investors and incentive for developers. So now, some numbers that's near and dear to, I'm sure, everyone's heart in the room, the IRR. First, the LP IRR is going to come out to 15.96%. That's 96 basis points higher than their maximum required yield that they were seeking. Now, the GP IRR for UDP is going to be 39.36%. That IRR compensates UDP for all of the sweat equity we put into the project as well as the long-term risk we took on it. The total project IRR is 18.16%. That's a solid overview of the whole project. It's a solid project. Now we run one final check. The sum total of the LP IRR and the GP IRR and the sum total of the cash flows both come out to $317,043,550. What does that tell us? That tells us that every single dollar is accounted for in this waterfall, and it can be adjusted accordingly to account for any cash flows that this project actually sees. Now that we have the cash flow distribution, how do we bring this to fruition?
What good is this building if you're not able to sell it? This is a profitable project, as Shanil has shown. But without the true marketing, there's no way that we can say that this is a solid investment. Traditional marketing is no longer enough. Print marketing and word of mouth is obsolete. It's nice to use a realtor. It's one way to fill a building. But if you look here on Google search, if you type in the words apartments in, you get 45,500,000 hits per month. That is a realtor's dream. People every day go online looking for places to live. Self-investigation is what they do first. People don't go to a third party when they just start looking. The first thing they do is they go and they research for themselves. So what I propose that we do is we do an online advertising campaign. We let the buyers research for themselves. By doing this, we can implement the website before the project is completed. By doing this, they can be looking, they can be excited about the project before we start. We will be able to offset the minimal costs of a web page by putting non-competitors on the page that would like to advertise. This is low overhead using a website, and it lets people look into the project for themselves. They can be excited about the project before it's even started. One thing that I propose that we do is we put in a website called apartmentsinhudsonyards.com. This will put us on the first page of Google. Now, just to get a certain aspect of this, 45,500,000 hits. 1% of 1% is double what we need to fill our building. We have a large target market that we can tap into by using the internet. This is significant hits and very helpful to us. These are some of the websites that we can have advertised on our page without interfering with what we're doing. Now, what we've talked about so far is our project, what exactly we want to do, the demographics of the area, and how we fit into it, how we can service those needs, how it wouldn't be wise to go into office or hotel. So by doing this, we also have a good way to market it. Are there any questions and comments? Yes. That's for apartments in. That's what people search first. Yes, Apartments Inn.
I think your idea of free marketing on the website is a good one. And I don't know, do your plans include other social media besides?
Any type of online media. This is just one avenue I thought that we could explore. We could do any type of social media, but just by doing that, it takes a load off of the, I guess, realtor perspective and the marketing perspective. It's one way that we can access an avenue that's growing. People are moving into online.
Exactly. The whole world is going from analog to digital, and that's the trend that you're seeing right now. So we're trying to capitalize on that digital trend of sales.
We're the first group to propose a ownership structure with two specific entities, two SVPs. And I heard you say that it sounded like part of your rationale was due to liquidity, and perhaps the retail LLC would be sold first and pay down debt.
Yes.
Yes.
Absolutely, exactly.
Talk about that a little bit and how that may or may not impact your ability to self-finance the resi portion.
Well, we feel it's not going to have that much of an effect of it because ground floor retail is pretty standard in lots of places in Manhattan, especially in the new and upcoming Hudson Yards. Similar to Times Square, they got a lot of luxury high-rises there where there is retail, and it's kind of, it's part of the game, but we're going to have a 5,000 square foot lobby with a separate entrance, so it's kind of be separated. So as far as that aspect, we feel it would work. And as far as selling the retail separately in the fourth year, it's a good idea because we could pay off the debt service and be debt-free, and not just pay down the debt service. We pay down the equity. We pay down the equity balance for both the GP and the LP, which pays down the pref balance, which just makes more of a profit split for us in the end, and less of a accumulating pref balance to go to the LP.
Does your analysis show year 4 or 5 the realization of the proceeds from the sale of the retail?
Yes. Next slide, please.
On the next slide.
Yes. Year 4 sale of the retail. It's right there. 7% cap rate. We were a little conservative with that. Retail's trade anywhere from, it goes from 5 to 8, but I'm thinking about 6% today. But we sell it right there for $179 million. That's including taking off selling expenses. Pay off our debt service. The remaining principal is $103 million. That leaves us with $83 million of cash flow. Therefore, we pay off our prep balances, pay down equity $66 million to the GP, and we pay down the equity balance $3.5 million to the LP.
Are you saying that your loan is fully paid off?
Yes, the loan will be fully paid off. We switch over to perm financing in year 2 at 6.5%. That debt service payment amounts to $8,027,000, and the remaining principal is $103 million. But we have $192 million coming in. We pay that down and pay down our equity balance. Then complete positive cash flow all the way to the end.
Yes.
Absolutely.
Rents were we tiered the rents. They increase as we go up, and we got the rents mainly from comps. So we really didn't have access to paid for data, so we couldn't get true comps. We couldn't go on Reese or anything like that. But from free sites, we came up with the rental rate. It started at about $62 a foot on the bottom, and it goes up to $72 on the top. So it's tiered up, and that's similarly in line. We looked at a product, 8 Spruce Street in Manhattan, and that's really one of the prime luxury multifamily in Manhattan, and they're asking 80 and above on the top floor. So that was, we're aiming to be that quality building, but still a little bit lower rents than that.
I'm sorry? At this time, it said that it was a developing area, so we figured we'd enter the market first. We'd get there first. We'd be able to get that target market. We'd be able to move them in. We'd start moving towards that development. As it stated earlier in the case, they're looking to incorporate a new park, a few subways, things like that. By doing that, they're showing that they want to grow the area. So we figured that this is something that would be worth looking into,
And our
worth
rents are real
incorporating.
conservative, especially on the retail. In the case, it gave the report of rents being up to $2,700 a foot for retail. But that's the best case scenario. That's Fifth Avenue. That's where people from all the world fly to buy the most expensive products are. We took it down to 500 and 600 square feet, respectively, because we had to be conservative. And we looked at the Real Estate Board New York retail report for the third quarter of 2012 and ran some comps. Rents were going anywhere from $300 to $2,700, directly in line with the project. So we stayed low at 500.
Yes.
Tiered solution, am I understanding correctly, that the affordable housing is on the third floor?
Yes.
The affordable
Yes.
housing is on the third floor.
Which we understand you can't accommodate them all to one floor. So
We were told that earlier today, that you cannot put affordable housing
they'd be
on the
split up
third
to
floor.
We pro-rate it all the way up, about three per floor.
Yeah.
Yeah.
And we describe it as on the third floor, but we'd have to prorate it all the way up.
prorate it all the way up, yeah.
New York law won't allow that, so. Sure.
Yes, sir.
When you sell the retail in year 4, what price per square foot is that set?
We didn't do the price per square foot, but if any of you had an HP 12C on you right now, I could do that calculation in 10 seconds flat.
You got it?
Oh, you do? You want me to run it? Okay, hold on. All right.
1 sec.
Let's see. Okay, that's 179 million. Enter, and the retail was 19,576 square feet, divided by 9,000 square foot on the sale.
Price to the retail is
9,000
9,000.
a foot. Let me run it one more time just to make sure I did it correctly. 197, 666, 666. Enter, and it was 19,000 square feet. Divided by, I got about 9,000 a foot. And you know, some retail selling for 13,000 a foot. That's some comps that did help from Real Capital Analytics. Here you go.
Thank you so much.
Thanks.
Thank you.
Called my bluff.
I'm sorry? Yeah.
Well, there is, but it's kind of difficult. Every block you go to is different. Like we just talked about how there's Fifth Avenue retail and there's Times Square retail, but it's really sector by sector. So you can run comps, but it's everything. Value is really established by the income stream produced by the real estate asset. So that's how we have to do it.
It was a little hard to find stuff like that, given the resource we were given. So right now, I don't nothing that I can think off the top of my head that.
I know there's
Unless you have something.
I know there's a building 11 Times Square in New York City. It's the last spec building that went up before the recession. And I know that they just filled up their retail, and I'm not sure if they sold it, but I know that it's a possibility. I think because they could sell that retail and pay down the equity to Prudential Real Estate Investors. So I don't really know, but I'm not sure per se if we do have a true comparison to your project.
Could you just walk us through, please, a recap of total construction costs? I'm not sure the land costs, maximum bid on the last page of your appendix, $3 million. Is that land only?
Land only.
It's land only.
All in on the land.
So what, and so what's your total cost basis to construct?
Well, it's that 103 million plus the interest required for the construction loan. That's about 15 million too. So I believe it's 118 million total cost basis.
Wait, that doesn't sound right, sir.
Okay. Cost of construction, hard and soft cost, that's right there, 104 million. You want the total cost of the project, that would be 104 million plus the land. But that's financed
Plus the land,
separately.
yeah,
But that's financed through construction financing. Yeah,
Solar
yeah,
costs.
yes.
Yeah.
So 207, you sold a retail for 180, and what do you think the resi is worth?
Next slide. Well, the resi at 5.25 in year 7 is worth 188 million, based on our analysis.
So you have better than a 2x return,
Yes.
more than 2x on your equity.
Yes. over time, of course, taking into account the time value of money, but yes.
So, just one more question. Sure. The different presenters today have had varying values of the land. And I think a lot of people have derived the value of the land based on what they plan to do with the property. But of the presentations I've heard today, your maximum land price is the highest, which by itself doesn't make it wrong or right, but I'm interested in learning how you came to that value. If it was derived, if it was based on cost.
Well, it's based on yield capitalization and the residual approach to valuation. If we pay $103 million for the land based on this cash flows, that's the maximum that we could buy this land for to deliver the 12% return to our investors.
So I understand that.
Okay.
Theoretical part.
Yes.
But what about the practicality of that? What is land sold for in Manhattan?
That's the good part about it. We used a conservative number to make sure that at least we were showing profit throughout the thing, showing that it was profitable in the worst case scenario.
Well, my question is a little different.
Yeah.
My question is one of relative.
Comps,
You want
comps.
comparable sites.
Has a similar site, size site in Manhattan, ideally in this marketplace,
Okay.
sold for a price
Well, some sites I know, like it's a site that has sold for a lot higher than that. Like I just mentioned, 11 Times Square, that sold for $306 million for that site, but that was a million developable square feet. So the ratio is actually kind of similar because this is 300,000 square feet at 100 million. So it's kind of 1 to 3. But yes, I know 42nd and 8th, the last developable space in Manhattan for office high-rise sold at $306 million in 2006, and I can guarantee that number.
Because your projections are somewhat aggressive, what do you think the most significant risk factors are that it might be?
Well, vacancy is a risk factor. I mean, Hudson Yards, the project, it's taken so long to get off the ground that the biggest risk is the rest of Hudson Yards. Is it all going to go up at the same time? That's why a hotel's not going to work yet, but it might work in the future. It's really the scope of all of Hudson Yards. Will it all go up together, and will there be that market for the whole thing?
The lease-up period would be the biggest factor that comes into this.
That's time.
That's it? Okay.
Thank you, everyone.
Thank you very much.
Thank you.